Today, what we'd like to do is sort of pick up where we left last week. And as we said, then we'll keep having these calls as long as the market's sort of in a state of dislocation. We'll keep addressing questions as they come up and keep you updated on what we're doing and what we're thinking about the markets. The first thing I'd like to do, though, speaking for myself, maybe 6 weeks ago when we were seeing headlines out of China about issues in the coronavirus, it really didn't seem tangible and real the way that it does now. I know personally from talking to family and friends who are in the healthcare business how serious this is now and what the objective is to fully understand how we're sort of managing the volume of cases so that we can meet that with proper care, and how important it is for everybody to sort of cooperate with the recommendations that are being made to us as a society. So I just want to acknowledge all of the people who are sort of on the front lines, and I think that's really important. Following that, what we'd like to do is sort of bring you up to speed on where we are from last week, the steps that we've taken, and how we see the whole sort of economic front developing. Doug, do you want to take the lead on that?
Sure. Thanks, Mike. And one thing that I would want to add to that, we're holding these calls to try to be as upfront and transparent as we can with our thinking and what we're doing in portfolios. I know we've also sent out trade notices and things like that, but with the massive amount of activity that's been going on both in our office and in the market itself, I'm hoping we are meeting expectations there. But if not, first thing I would say is I apologize for that. But we would also love to hear any feedback on how we can improve that, just so everybody is kind of up to speed with what's going on, both in the market and kind of what might be going on in accounts. So with that, I'll kind of jump into the meat of the call here. The last time that we spoke as a group, we focused more on kind of the virus, the spread, and kind of how it was affecting the beginning stages of the economy. And it's kind of crazy in 7 days. I could probably spend an hour and a half going through things that have happened. I won't do that. But I do want to touch on some main points. The first being, we put out a market insight last night that laid out some of the things that we're concerned about, and then that ultimately led us to further reduce risk in our portfolios. And I want to go over those things right now. The first is, and we did mention this on the call last time, Sunday night, the Federal Reserve came out with what many termed their quote unquote bazooka. They announced a 1% cut in interest rates. And if you remember, this followed the 50 basis point or 0.5% cut that was done on an emergency basis just a few weeks before that. And then they announced a $750 billion quantitative easing program, which quantitative easing is basically their way of buying treasury bonds, mortgage-backed securities, and anything that supports kind of the functioning of the credit market, so to speak. One of our big concerns going into this was that there's been this buildup over the last probably 11 years that in any bad market situation that we may run into, the Federal Reserve will always be there to save us, so to speak. And when they came out with this announcement, was a Sunday night. The following day, the market sold off 12.5%. So that was kind of a psychological kind of safety net that, in our opinion, had been broken a little bit. And that was extremely concerning for us, and a point that, like I said, we had mentioned on the earlier call, and seeing that price action was something to us that was very concerning. The second thing is that what started out as a stock market problem has now morphed itself into a bond market problem and quite frankly, a money market problem. We mentioned how the oil shock from the OPEC meeting last week was kind of the trigger in all of this to get the massive amounts of volatility that we saw in stocks kind of metastasize itself into the bond market. And what we're seeing in the credit markets right now is things that you haven't seen since 2008. You're seeing massive dislocations in the prices of things like high yield bonds, treasury bonds, ultra short duration bonds. So we're talking about investment grade commercial paper, things that's maturing in 20, 30, 40, 60 days that is trading nowhere near where it normally would. And those dislocations are the things that can cause markets to go from 20% down to 40% down to 50% down very quickly. Now, one point I do want to make, you may hear me use a lot of terms that compare things to 2008. We're certainly not here to call that kind of market decline, but we are starting to see similarities pop up to use those comparisons, I think is appropriate in certain circumstances. So that was really the second thing. The third thing, and I think this is something that we'll build on some other questions, but I think we as a country now are coming to grips with something that I don't think anybody has ever faced before: the prospect of basically shutting the country down. And as analysts are coming to terms with that, they're trying to figure out what that looks like. I just saw a report come out right before I hopped on this call from JP Morgan that they were expecting first quarter GDP to be down 5% and then second quarter GDP to be down as much as 14%. So those are some serious numbers, some serious deterioration in GDP that is usually only reserved for severe recessions or, and I hate to even bring this word up, but depression era economic growth. So when we're starting to see these things, we're starting to come to grips with it, the massive level of uncertainty that we're facing to try to figure out what fair value is, it's going to take some time to sort all that out. And as Mike mentioned, usually we overshoot on the upside and on the downside. So, for us to take a step back and look at this and to say, all right, we need to reduce risk even further from what we would do in an environment that's already sold off pretty significantly, it's really under the expectation that things could certainly get worse before they get better. Now, we hope that's not the case, but we want to plan for that because there's a lot out there right now that's causing a massive amount of uncertainty in both the markets and, quite frankly, society as a whole. So, Mike, I'll go ahead and stop there, and if you want to add anything or go to questions, we can do that.
Well, I would like to tackle the questions, and if you are near a computer, and just like last week, if we bring something up and that spawns a question, go ahead and send it to the same email address you received the invitation from. That's the info email box. We're monitoring that. We'll be able to tackle those questions in real time, hopefully. So with that said, I'm going to go ahead and jump in. I'm going to start with a very nice question to begin with because somebody's worrying about us. This is, believe it or not, this is the third time today that I've seen something like this, which is interesting. And I'm grateful for that. Anyway, the question is, other than staying home, what can we do to help small family businesses like HCM during the next few months? Obviously, it's essential that they stay in business for their own employees, but it's also essential for all of us to have businesses that we value that we can return to re-energize the economy as quickly as possible. What can we do to help them weather the storm? So the first thing that I wanted to say is that I appreciate those sentiments. HCM is actually a reasonably large company. We're certainly not mega sized, but with 25 employees, clients in some 30 states, we are very well grounded. From a financial perspective, we follow our own advice, so we have financial safety nets for just these types of situations. We take on no leverage. We're obviously diversified. So don't worry about us, although we appreciate the sentiment. It's important to remember that our role is to help people make good long-term decisions to build financial independence and maintain that financial independence. So times like this are challenging for everybody, but these are the times that really make the differences. I've been through 5 great wealth building opportunities in my professional lifetime, and this is number 6. So the opportunity presents itself if we all keep a level head on our shoulders and respect where the risks and the opportunities are buried. And you don't have to make perfect decisions. I think that's the first thing that I'd like to emphasize. Nobody has to pick the bottom or pick the top. I have a couple of stats on how long bear markets some of the recent bear markets have lasted, and how long the following bull markets ran, and what the differences were. But the point is getting the bulk of the decision right, and all of this may be a bit of a Machiavellian type response. There will be people who make emotional decisions that are mistakes, and the appropriate level-headed thing to do is be prepared to take advantage of those mistakes when they occur. Those relate to the excesses that Doug mentioned could occur. Right now we're in fairly typical bear market territory. Should we get truly extreme rash reactions, I think I used the cliche last week, but when the baby gets tossed out with the bathwater, we want to be there to happily purchase securities from those people who would be willing to sell at any price. So again, in understanding what we do, it's important to remember that we're thinking about the full investment cycle, not these. Certainly these couple of weeks are critical, but we're always thinking about these things from beginning to end and trying to manage throughout that. So all of our financial planning process feeds into the portfolio component in how we manage the risk, how we build the safety nets, and those sorts of things. I would take it a step further, though, because while I don't see us as a small company, there are people in the economy who were literally put out of business overnight. And I would suggest, if you have the ability, if you're barber or hairdresser, that you see regularly and you value their services and you've been seeing them for a long time, go ahead and the next time you see them, pay them $500 for your next 10 or 15 or 20 haircuts. Continue to order carryout from the restaurants that are closed but are still doing carryout. When you do carryout, tip the person that hands your pizza across the counter as though they had just waited on you, so that you can keep those people vibrant and healthy. Those would be, recommendations from that perspective. Another question, so that kind of wraps that one up from my point of view. Anything to add there, Doug?
No, I would not add anything to there. I would share that I've been working from home for the past 2 days, and I guess the only thing I can say is, be nice to your family when you're going to be kind of cooped up with them for a while. So Doug is working at home. Just as a sidebar, we have made the decision to split our team in half.
So we are rotating, keeping half the people at home and the other half in the office. We found that that's a good mix. We can be as responsive as we need to be, but we're keeping our social distancing that everybody's talking about. So that's how we're operating. Next question, do you see any positives coming out of all this other than simply having lower stock prices? Doug?
Well, I think you will see some positives eventually. It's hard to see it in the moment. You know, in any business cycle, recession is really just the, you know, kind of cleansing of excesses. And we have not had a recession. And I guess I should caveat this with, I can't say for sure that this is going to lead to recession. I have a hard time believing it's not going to. So we can just operate under the assumption that that's kind of where this is going. But you know, that process, it's important in the business cycle because it takes businesses and practices that would under normal conditions be unprofitable, and it removes them from the equation. So I think over the past 11 years, we've had some very loose policies from a monetary standpoint, and it's quite frankly, it's led to a lot of excess risk taking in spots of the market that probably didn't need it. And I think right now unfortunately you're getting the unwind of a lot of that excess happening very quickly. So in the moment, I think it's very hard to kind of take a step back and see that. But I think when we come out the other side of this, eventually, you'll hopefully have a healthier market going forward.
Okay, perfect. Some questions that have just come in recently. Let's see. What effect do you think that the proposed federal stimulus packages will have on the economy and the market? And those are two different, the economy and the market are two different things entirely, I would say.
Sure. So I think the monetary aspect of this, we've already touched on it. I mean, they came out with the bazooka and it kind of was a dud. Now, that doesn't mean that they can't come up with more plans, so to speak. From the fiscal side of things, right as the market was closing today, you saw a little bit of a rally into the close as they approved. I don't know what the exact name of the bill was, but the details seem to be along the lines of adding unemployment, adding sick leave, basically helping anybody who would have to stay home from work and make sure that they still get paid. Now, I think in the moment, and I think from an optics standpoint, these things are important. Do I think it's going to be enough to change the trajectory of what we're seeing? Probably not. I mean, if you think about what we're really talking about is, you can almost look at it two ways, and I've seen two extreme kind of takes on this, but I think each one offers a unique perspective. So one I've seen from a gentleman named Bill Ackman, who's a hedge fund manager and a pretty prominent guy. He is basically suggesting that we take a 30-day spring break and essentially just shut down everything, including the market, for 30 days. With his point being that the economy can handle 30 days of being shut. What it can't handle is 180 days of these rolling regulations where people are always looking over their shoulder, maybe expecting something more to happen, or just keeping that level of uncertainty, so to speak. Now, on the other side of things, I've seen people say the only way to truly stop this is if you do something like that, but then you bring in serious economic consequences that most people wouldn't be comfortable with. So their suggestions were quarantine, the at-risk individuals, those who have lung issues or folks over 65, and just tell everyone else to, hey, go to work, go along to business as normal, and roll the dice and hope that you survive. I mean, and again, I think both of those are really extreme ways of looking at things, but I think that the answer from a fiscal standpoint, you can't really throw money at that problem either way. I mean, you can make an effort to pass bills. We can balloon the deficit. The initial estimate for the spending package, I think, started at 850 billion, then it went to 1 trillion, now it's at 1.3. And I was on a conference call last night with somebody who suggested that by the end of all this, it's going to get to 3 trillion. So how that helps the market, it's hard to say. I think you may get a little boost in sentiment, which, you could lead to a little bit of a counter rally. But for every layer they add to this, there's also a trade-off. So yesterday you saw the announcement of all of this fiscal stimulus, and what you got was bond yields starting to rise, with the expectation that we're just going to spend money into oblivion. You bring in the possibility of inflation. We've already seen what happens to the economy in this market with higher rates. So it's going to be a tough road to navigate, and I'm not 100% sure that there's anything from a fiscal standpoint that's going to solve this. But from an optics standpoint, I think there could be some spots where you get a little bit of a relief rally in the market just because they're quote unquote doing something.
So I think the takeaway from all that is from both a fiscal, the government, whether it's on the tax side or supplementing benefits, healthcare, and so forth, those are things they have to do, and those are costs we have to bear. But what really has to happen is we need to see the number of cases go down and have some clear transparency as to when we will be able to treat this virus and stop it in a more conventional way. Otherwise,
yeah.
Go ahead.
Yeah, I would agree with that, and I think unfortunately we don't have those answers right now.
Yeah, so there are Manhattan-style projects underway to reach that conclusion, and that's probably what it's going to take. Looking historically from the way we would expect the markets to react, I said a moment ago that the distinction between the economy and the stock market are two very different questions. It's likely that the economy, because it's basically being thrown into park almost overnight, restarting it is going to be quite a challenge. However, our expectation is that if we get that clarity with regard to a way to treat the virus, there's basically an effective vaccine, that we could see an almost overnight immediate V-bottom type reaction in the investment markets. So the investment markets will likely front run the recovery in the economy, and that is our base case expectation, and that leads into some of these other questions that we have. And I'll take the next one that kind of feeds into that. When the time is right, will you start purchasing undervalued stocks? How will you know it's time to do that? That's an easy one, Doug, so I'm going to leave that up to you.
All right. So our goal in this full cycle is definitely to be aggressive in re-risking accounts when the time comes. The issue is no one knows for certain when that is going to be, and we're certainly not here to tell everybody that we're going to pick the exact day of the bottom, nor do we think we need to. But let me just give some anecdotal examples of kind of what I'm referring to. So last night, FedEx, global company, ships stuff all over the world, came out with their earnings from the previous quarter. Good results. Then what they did was they just pulled their guidance for the rest of the year. They said, we're not even going to give you a number. They're not giving you a number because they don't have any idea. And if they don't have any idea, the analysts that cover the companies, they don't have a clue then. All right. So what happens is, when we talk about valuations, when we talk about things being cheap, I think sometimes we fall into this trap where we just look at what the price level is and we say, oh, this has to be cheap because it was 50% higher, 6 months ago. Well, there's a popular valuation methodology called the PE ratio. So it just stands for price to earnings, right? So you need two inputs there. You need a price earnings, and that gives you a multiple, okay? So that multiple, when things are going well, investors are willing to pay a little bit more. P. They're willing to, I guess, spend more money to get a dollar of earnings is another way to look at it, all right? So let's say that you have a stock that's trading at $200, we'll call it, all right? Earns $10 a share, right? So that has, I'm sorry, let's do 200, earnings of 20. So that is a P of 10, all right? Now let's say we cut the earnings in half, right? So we cut that down by 50%. So now it goes to 10, right? So that multiple applied to those same earnings, that price gets cut in half. But now in an economy that's not growing, are people going to be willing to pay up? Are they going to pay the multiple that we've seen in this growth environment? And if that comes down, then you start to see how the price levels and the projections can get lower and lower and lower and lower. And to give you a little bit of an example, in the past, I think 10 recessions that we've seen, the average earnings decline has been right around 16%, okay? So it doesn't sound very bad, but then you go back to the last two. 2001, you had a 45% earnings decline. And in 2007, peak to trough, you had an 88% earnings decline. So where does that lead us? The valuations right now, people are still trying to figure out what fair value is for some of this stuff going forward. So when we look at a price and say, oh, wow, this price looks great. I mean, Boeing is a perfect example of this. So Boeing was a $400 stock, or close to a $400 stock, I think 6 or 7 months ago. I'm sure anyone who would have looked at it at 200 would have been like, oh, wow, this is a great buy because it's 50% lower than what its high was. You could have bought it today for $90. And there's some people that think Boeing is actually going out of business without a government bailout. One more quick point on this is that you've heard rumblings of any company that takes bailout money would be barred from using that, from buying back their stock going forward. Some say would be an indefinite ban. If you look back over the past 11 years and you see the amount of stock buybacks that have been undertaken and the positive effect that that's had on earnings, if that goes away as a stipulation of a bailout, now you're talking about a whole nother dynamic of trying to figure out what a company's earnings are going to be going forward, and therefore trying to figure out what fair value is. So we are certainly going to be buyers, and we want to be buyers, but at the same time, we also want to do so with our eyes wide open, knowing that we've got accurate data to make the best decision possible.
Okay, I'm going to give a shorter answer to the same question. That basically is the culmination of everything Doug said. There are three things that could cause us, from my perspective, to change from sort of hoarding our safe money. The one is just a blood-chilling washout. So that's my baby with the bathwater example. That we would measure with technical measurements, but it would be something, for a biblical style proportions. It was just an incredible washout. The second is simply a reversal of the statistics. It's possible, while we think our sort of base case scenario is that the market will rebound in a very rapid way after we get clarity about a vaccine or treatment. It may be that it doesn't work that way. It may be a slow grinding recovery, in which case a lot of the indicators that we monitor will slowly begin to turn, as the market sort of moves sideways, will begin to turn positive. That would be a reason for us to re-risk the portfolios. The last would be just a continual decline. So it's not that big whooshing washout, but if things got to be so cheap, like by historical measures, that they matched everything that it had done before, we would then begin a gradual process of re-risking. So all those are sort of the culmination of what Doug was explaining, but it maybe adds a little more visual context to how we might handle things. We did have a question just literally come in. It's one that we can't answer, unfortunately. It's company specific with regard to P&G compliance. Will not allow us to deal with company specific questions in a public forum like this. However, feel free to check with your advisor. We do have a P&G specialist on staff that keeps very close contact with the company and the pulse of things there. So that's the way we would handle that. So next question. In our opinion, are we going into recession, and what will that mean for the stock market?
I would put the percentage, well above 50, probably in the 75 to 80% range at this point. And not, that's not just our firm's opinion, but, backed up by a lot of, the major Wall Street houses. Like I said, Goldman Sachs came out with a minus 5% GDP projection. I've seen as low as minus 14. So it's really hard to believe that we would sidestep a recession at this point. I think the question is it a shallow, quick recession, or is it a long and deep recession? If it's long and deep, then we may have some more pain ahead in the equity markets. As I mentioned before, the peak to trough drawdown in 2008 was 50%. We're probably about or a little bit more than halfway there, as scary and crazy as that sounds. If it's shallow and quick, then hopefully we can get a quick V-shaped recovery that everybody's hoping for, and I think things would be a little less pronounced. So I think if there's a way that we can avoid recession altogether, that would obviously be the best case scenario. But it's seeming like that's going to be almost an impossibility with the news that continues to come out.
And I would agree with that. I tend not to get too hung up in the nomenclature. Officially recessions are declared after the fact by back-to-back quarterly declines in growth and so forth. For me, it's just a practical reality out of necessity. As I said before, we've taken an economy that was running at 60 miles an hour, and we've just jumped on the brakes and thrown it in park, and that's going to have consequences regardless of what we call it. And those consequences have to be dealt with the best we can, and that's where you see all the stimulus and programs coming from the government. Nevertheless, when people are afraid, it's going to take some time to get that economy restarted, even after the vaccine is out. I'm going to change from the stock market questions. By the way, we originally said this would go for about 30 minutes. There are a number of questions, so we're going to stick around a bit longer and see if we can answer these. But we won't let it go longer than an hour. So we'll wrap it up at 5:30, no matter what. So the next question, what percentage should be in bonds? What percentage should be in mutual funds in our portfolios? Should we have funds that are quarantined? I'll give you my thoughts on this for a minute, and then Doug can chip in.
Sure.
So the stock and bond allocation, so everybody that is a client of HCM has been through a planning process. You've been through an investment policy design that partially measures risk tolerance. As I like to say, that's your risk component that's between your ears, and then risk capacity, which is the amount of volatility that your portfolio could tolerate based on the financial plans that you've laid out and survive in good stead. So that mix is personalized, depending on one's risk tolerance and actual risk capacity. So it doesn't exist for one single person. The question goes on to say, what percentage should be in mutual funds? I'm going to go on. I'm going to nitpick this question just a little bit to make a distinction. One can invest, let's just limit it to stocks for the sake of discussion. One can invest in stocks in a number of formats. You can actually go out and buy a particular stock. On the call so far, we've talked about Boeing, for example. You can buy Procter & Gamble. You can buy Amazon. So you can buy individual stocks. Or you can buy those stocks through funds. There are one way to do that is through exchange-traded funds. Those tend to be much lower cost in how they're assembled and managed. And this question says, what should be in mutual funds? Mutual funds are a different kind of animal, and more often than not, they are more expensive solutions. At HCM, we try and drive the investment cost out of the portfolios where possible. So we try to avoid using mutual funds. So I'm going to reword the question and say, what should be in bonds and just what should be in equities versus what should be in funds of some sort. So I'm just going to modify the question in that way. So again, the first part, stocks, bonds, cash, alternatives are going to be unique to the individual. The method of investing is going to be a little bit different. So something we touched on last week, I'm not sure if everybody was here. HCM takes two very different approaches to how we handle accounts. This is a decision that our clients make with their advisor. We have tactical solutions. So when Doug was mentioning earlier that we have cut our equity exposure on multiple occasions now through as this bear market's been advancing, those are tactical adjustments that we make to reduce the risk in the portfolios. We do that usually with those solutions we view as being more appropriate for people who are approaching retirement to manage a thing called sequence risk. I'm not going to get into the weeds on the details, but sequence risk is something that is more damaging to people who are forced to take money out of their portfolio to pay their bills, and those are people who are no longer working. Now, HCM has a whole slew of protective things that we do for people in that situation, and one of them is managing risk through tactical adjustments. The other very discrete way of managing portfolios is through strategic solutions. Again, another big word. That basically involves a sort of a pre-programmed formula of rebalancing the portfolios as the market value changes. So as stocks were rising, say that your goal is to have 70% of your portfolio in stocks and 30% in bonds, for example. As the stock market would rise and say the stock part of your portfolio just grew into 75% of your portfolio, we would naturally, as part of the process, sell that 5% to bring the weight back to 70% to keep the portfolio in balance. That same process applies when the market's declining. So for strategic portfolios, as the market's been falling, we have triggers that will trigger that rebalancing, and we reposition the portfolios regularly as those triggers get activated. So for the tactical portfolios, the percentage that should be in equities has been reduced in order to manage the risk. For strategic portfolios, the percentage is constant and being held constant in an intentional way in order to take advantage of the falling stock prices. The idea there being it's a forced process that forces you to buy lower, not necessarily low, because when the process starts, stocks may still be relatively expensive compared to their fair value. But as prices continue to fall, you're constantly buying more at lower prices. And over the long term, when the market recovers, you'll have more shares to benefit from the recovery. So those are the two ways that that's handled. The last part of the question was, what percentage should we have in quarantine funds? I'm going to translate that into our tactical solutions, where we are, in fact, we have increased the money in bonds and cash through these sales, so that's part of it. And I emphasize cash because typically we would take that money and invest, when we sold something, we would invest it in short-term bonds to get a little bit higher yield. But one of the things that we're concerned about, we consider it highly unlikely but not impossible that the markets may get a bit of a holiday. If they put a quarantine in New York, who knows? And we wanted to make sure that our clients always have access to cash, so we didn't want to be in a situation where if somebody had an emergency and needed money and therefore needed to sell something, even if it was just liquidating a money market fund or a short-term bond fund, in other words, safe money, if the markets were closed, we wouldn't have access to that. So we are holding some cash, so if you see that in accounts and wonder why we haven't invested that, that's the reason why. So the quarantine funds are those assets that we have set aside in that way, and in the tactical accounts, we also have money that are on the fixed income side, what we would consider the safe assets, that we will, when we do make the decision that we want to re-risk the portfolios, we will reallocate the tactical accounts. So if somebody had been, say, in a 60-40 type allocation, and we've now reduced that allocation through these stock sales because of the market, when we get back in, we will go ahead and scoop up some of those assets from the fixed income side so that the equity allocation could be bumped up from 60% to, say, 70 or 75%. Again, the objective is to have fewer assets exposed to risk when we think the risk levels are high, and more assets exposed to risk, potential gains when we think the investment risk is low. So hopefully I've adequately over-answered that question, but answered it completely. Another question came in. How do you suggest that people manage their cash flow in the next 6 months? I will stay with that one because it's a little more on the planning side. Remember that if you are a planning client of HCM, you have an emergency fund that's established that we keep, whether you know it or not. If you have planned distributions anytime in the next 5 years, then we've established the safety net that takes into consideration your cash flow needs, any extra purchases that you've told us about. If you buy cars every 5 years, and if that's going to happen next year, then we've set money aside for that. We plan for the cash that's going to flow, whether it's Social Security, pensions, interest, dividends, things like that. We assume nothing coming from the markets over that 5-year window, and we take into account your tax liability. So we've planned for all of that. In terms of cash, other cash flows, then the idea is that if we've done the planning properly, you can live your life pretty much the way you always would, because we've got these reserves in place. If by some chance we wind up with a true outlier event, something that has never occurred before, then you should know that we also have, in the planning that we've done, is what we refer to as a distribution policy statement. That policy statement takes the planning calculations that you're all familiar with and pushes them beyond regular limits so that we can see at what point we would come to you and say, you have to rearrange your spending a little bit in order to stay within the success rates that we target. That has never happened yet. It could happen, obviously, because we don't know. I mean, we just don't know what we don't know. But because of that, we have gone out of our way to already make plans so that we can anticipate those things. We're a far cry from having, if you had solid plans in place that hit the 90% thresholds that we target, what we've been through now is not going to rock that boat at all. It would have to be a really serious event. So really the takeaway is, and if those things happen, quite frankly, you're going to be tightening your belt yourself because it's just natural solution. And it won't even feel like your belt's been tightened because everybody's in the same boat. In my experience, the only time that people really are uncomfortable with those kinds of adjustments is when it's unique to them. If something really, if they made a very bad financial decision within their own family, or if some event occurred and for whatever reason their sort of relative status is changing, in my many years of doing this, that's the only time that we really get into those issues. But rest assured that we've planned for all of these things and have for a long, long time. Next question, what is the most concerning thing you're seeing outside of falling stock prices? Doug, you want to take that one?
Yeah, I mean, there's a lot of things right now that are concerning. I mean, the virus itself, what it's done. I think, anytime you see entire cities being locked down, that's something that, quite frankly, I'm not sure that any of us have seen before. But I would say outside of the equity markets, the most concerning things we're seeing right now are just kind of the reaction of fixed income assets that would historically be very safe. We've seen extreme moves in Treasury prices. I think that the 10-year yield went from right around 1 today up to, I think, as high as 112 or 113. So when you're seeing 13% moves in the 10-year Treasury rate,
I'm going to interject a little bit, and I just want to call the Wall Street gibberish on you. So you're talking inside Treasury markets and basis point moves. Put that into, I think you might have been getting there, but into layman terms, what does that? Why would I care?
Sure.
That there's,
well, because the rate should not move that much. I mean, it's usually a stable rate. It's not going to fluctuate a whole lot. There's a lot of things from a lending standpoint that are based off that rate. So it just shows a tremendous amount of volatility in an asset class that usually doesn't have much. We've seen, as I mentioned before, the commercial paper market, so very, very short duration loans that companies have given out that may do things like help them meet payroll or finance projects they're working on. And when those things are moving at, in some cases 5 to 10 times the price movements that you would normally see, it certainly grabs your attention a little bit. And I think outside of the normal stuff that the Fed has done, they've also tried to institute backstops for these markets because, frankly, the only time you hear about them are when really, really bad things are happening. So I think if they can shore those markets up a little bit and take the volatility out, that would be a good starting point.
Okay, thank you. We have about 7 more minutes. We're going to maybe go into a little speedier version and try and finish up as many questions as we can. This next question, Doug, is probably for you. It has 1 or 2 individual stock components to it, which we can't address, but the overall question, I think, is legit. Which sector or sectors do you ultimately see coming back first? Things like software services, example, Salesforce and Adobe, financials, industrials, retail.
Yeah, I mean, it's what would come back first. I think there's a what would come back first and then what would come back with maybe the most ferocity. The 2 that come to mind that have been beat up the most, the first being energy. A lot of energy companies are going to go out of business. I mean, that's just the long and short of it. And then you have the financial sector, which has kind of been hit with a double whammy of things. So I think if you could navigate those sectors, that's probably got the biggest return potential. But again, the bottom of those things might might not be close to us. So you really have to kind of tread carefully there. What would be a good spot to be right now? Probably your defensives, your consumer staples. You're looking at things like grocery stores that are still performing well. I think Walmart was actually up today, which is a position that we own. But yeah, it's hard to say exactly what is the first thing out of this, but probably the things that have been beat up the most stand the chance to show the earliest signs of quick recovery. But then again, they also have the most risk, even at this point.
Yeah, I would add, so there's sectors, like industrials, retail, technology, things of that nature, and also asset classes. So typically, once the bell is rung and investors en masse are of the opinion that it's time to buy, typically the slang term, now Doug could scold me, the higher beta positions, but the most volatile positions, the ones that kind of led the charge on the way down, are the ones that would tend to lead the charge on the way up out of the gate. So investors will buy the most volatile positions, trying to get that most volatility, most bang for their buck that they can. And that'll be found in areas like smaller cap stocks. Emerging markets was an area that before all this started, pretty much universally, all institutional consultants were recommending EM because it had such a tough time and the world was looking good there. That's a highly volatile area that if the debt markets can get squared away, would be an area that we would be looking. Technology is obviously a way of the future, and another area it's obvious right now in the middle of things is healthcare, biotechnology, things of that nature is certainly a component. So those are all areas that tend to be volatile and could potentially lead the charge out of the bottom. We've made a comparison to the Great Depression and Great Recession. However, before this crisis started, the economy was in pretty decent shape. Do we feel the market as well as the economy won't come right up as the storm passes? Of course, we would see unemployment go up, but that should go down as companies start producing again as well. That's maybe as much a statement as a question. Do you have any comments around that?
Yeah, one thing that I would point out, while the market has been doing well throughout all this, I think you could make the argument that the economy, I don't want to call it weak, but I don't think that strong economy is a good way to put it. If you look at all of the recoveries that we've had coming out of a recession, this has been the longest recovery, but it's also been one of the weakest. So when you're looking at that and saying, oh, it was strong to begin with, it should come back really strong, I don't know that the foundation was where it needed to be at the beginning of all this, which is maybe why we're seeing a 30% decline in a 20-day period. But as I mentioned earlier, recessions are the time where excess gets cleansed a little bit. And I certainly would hope that coming out of this, we're able to, get on a little bit more solid footing.
Perfect. Thank you. Did you have something to add? I'm sorry.
Nope, that's it.
Oh, okay. How does the current crisis differ from the general approach to planning for retirement? I would say that it doesn't. These are the sorts of things that, bear markets, retirements can last for 20, 30, 40 years if somebody retires early. You can expect to go through a couple of bear markets potentially during a typical retirement. As I was saying earlier, there's a lot of things that we do to prepare in the event that the bear market comes early in retirement. That if you're lucky, they come later, but you have to be prepared if they come earlier. So it's just a standard part of planning. It's if you have proper reserves and keep the ability to take advantage of those emotional mistakes other people will make, you can enhance your future. from a retirement, for the financial side of retirement. Next question, will things be different if we are 60 and about to retire, or if we're planning to work for another 20 years? I would say yes. We talked about those two different, very distinctly different ways that we handle money, one being the tactical solution versus the strategic solution. The strategic solution is definitely more appropriate for people that have a longer runway. The tactical solution is, we believe, more appropriate for those who will be retiring in the relatively near future. Beyond that, the things that you do in your planning, building the safety nets and those sorts of things, are all things that you would do if you had retirement in your sights within the next 5 years. So that would be a component of your portfolio that you would not have if you were still 20 years away. So those are some of the differences that I would see. So it is now 5:30, so we're going to go ahead and close the call, and I think that tackles most, if not all, of the questions that we had come in. The last thing I want to do, I just have a chart here. I'm just going to give you some quick numbers. I said earlier that there have been 5 big wealth building opportunities in my professional career, and that I definitely believe this is number 6. I just have a chart that I'm going to just let you just kind of recite the time that the bear market happened, the loss in the bear market, and what the recovery was following that, to give you some perspective. And what I want to do here is allow people to get some sense of duration, because that's a question that has come up. How long do these things last? And why we say it's not critical to pick the very bottom, why we're comfortable having some dry powder as long as we can get on the right side of the recovery and relatively early. So this is going to go back beyond my career a little bit, but they're on the chart. So going back to the 50s, in 56, there was a bear market, lasted about 14.7 months. The market dropped about 22%. The recovery that followed it, the market was up 87%, and that recovery lasted about 50 months. The next one in 1960, well, a little after, in the early 60s, market fell 28%. The recovery was nearly 80%. The market after that, and that bear market lasted 6.5 months. Following that, in the late 60s, there was a bear market, lasted about 8 months. Decline was 22%. The recovery was 48%. Following that, a bear market lasted 18 months, fell 36%. The recovery was 70%. So you can see in each of these, the recoveries are multiples of the loss. The next, in the early 70s, the market fell nearly 50%, but the recovery was 125%. In November of 1980, a bear market lasted 20 months, declined about 27%, but the recovery was 228%. Coming on now to things that we all remember. In August of 87, we had a bear market, about 33%. It was very short. It would only lasted about 3.5 months. That was the Black Monday time. But coming out of that, the market rallied 580%. So that was, a spectacular bear market. Then we got into the tech crash in 2000. Market fell about 36%. That had a couple of legs in it, but ultimately the recovery was over 100%. We come into the most recent where we saw the market fall. This goes back into the '08 period. We saw the market fall a little over 50%. And of course, we've had rallies coming out of that of over 300%. So it's not uncommon to see the markets fall 20, 30, even 50%. The old adage, the harder they fall, the bigger they're going to rally after that. Maybe I just made that adage up myself. Yeah, I think bigger they are, the harder they fall. But you get the gist of that. So again, the point is that if we've got dry powder, we've made some good decisions coming into this. The strategic portfolios continue to buy at the lower prices, and we've got money not only then in cash from things we've sold, but in the fixed income side, because we came into this in a neutral allocation. So we've got lots of bonds we can reallocate to catch those recoveries. We've got safety nets in place. We are in good shape to weather this storm. We will, then really want to conclude the call then. We will do this every week as long as the markets are rough, to kind of update you on what we're doing and what we're seeing. Obviously, if anybody has any particular questions, feel free to reach out to your advisor. We are happy. We may be scattered, but we're all available. We're all working all day. And the last thing I want to do is close the way we opened, sort of tipping our hat to the first responders, the people who are putting themselves on the front line, risking getting sick in order to keep everybody healthy. Encourage everybody who a month ago might have thought some of these precautions were silly. I think we can all see now why they're relevant to protect the healthcare system. And just wish everybody to stay healthy. That'll do it for this call, everybody. Thank you for tuning in. We will have a recorded version of this up on the website shortly, probably sometime tomorrow. Thanks, everybody. Bye-bye.